We're here in Monte Carlo for the Rendez-vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Jerome Haegeli, who's Chief Economist at Swiss Re. Jerome, welcome.
Great to see you, Richard.
So here in Monte Carlo, lots of discussions going on between insurers and reinsurers and brokers, but investors as well. What consideration are investors and potential investors weighing up?
Well, it's great to be back, and it's great to meet everyone in Monte Carlo. A lot is going on. There's a lot of uncertainty. There's macro uncertainty, inflation risk. Inflation risk, in my view, is still the near-term macro risk. So how does inflation still impact reserve adequacy? That's an important question. The other big question is also climate change. How does climate change, together with urbanization and the accumulation of wealth, continue to impact Nat Cat events? And then, last but not least, there's also the question about the course, the future development of interest rates and how the interest rates affects the insurance market profitability, and the ability of insurance players to provide capacity.
So a lot of things for everybody to consider there, but particularly for investors, how has their appetite for insurance risk developed?
I think it's a really good environment for the insurance markets. The repricing of risk. If you just think about interest rates, it's really important that we had seen this repricing of risk. Finally, risk-free rate is not return-free anymore, and we have lived for a long time, 15 years plus, with nominal negative to very low interest rates. That has changed. That the interest rate regime change is now part of history, and that allows the insurance industry to be much more profitable for the new business. That's a really good thing. In terms of underwriting cycle, where we are today, I expect the insurance market pricing cycle to remain strong, to remain hard. Why? Because of the reasons just mentioned. Uncertainty, macro uncertainty is still with us. And please don't forget, yes, inflation risk is coming down, but disinflation is not deflation. And the inflation shock that we had seen, it's still in the system.
So typically, hard insurance markets last less time than soft insurance markets. How much further have we got to go?
Well, obviously, it's the number one question. However, given that we had this extraordinary inflation shock like we haven't seen before, or most of us haven't seen that before, I think it will last well into 2024 in terms of how long the insurance market hardening will last. Inflation shock is nothing like we had seen before. Interest rate tightening is the fastest in 40 years. And that gives me all reasons to believe that the underwriting cycle has further room to go.
And will that encourage more capital into the market?
At some point, one would hope, yes, it will. And definitely it will. If you think about the new business profitability, it is for the new business. And as our latest Sigma research that we just published yesterday show, finally the P&C industry is able to earn its cost of capital for the new business. This wasn't the case. And with the industry being able to earn its cost of capital, it will be able also to grow its own capital. This being said, if you look at where we are today, in the supply of reinsurance capital, it's still pretty constrained. You see ILS market growing, but you also see collateralized, securitized reinsurance solutions being rather flat. So I think there's still a supply-demand imbalance, and again, that speaks for continued rate hard marketing.
So a lot of uncertainty, a lot of risk out there in the world. How well set up is the reinsurance market to take on that risk?
There's probably no other sector than the reinsurance market, which is dealing with risks as we have it. They are pricing the risk, they are investing in the risk on the asset side, and obviously underwriting the risk. And again, with the repricing of risk-free rates, the industry is extremely well suited, I think, to cope also the challenges that we have today, but also tomorrow. And I think here also about global protection gaps. Let's not forget, global protection gaps are at a record high, $1.8 trillion. That's a record high. We are seeing still an imbalances of supply and demand, but with the profitability of the new business, there's probably hasn't been a time like now over the last 10 to 15 years, which is as good as now for the industry to cope with the challenges that you just mentioned.
So the protection gap is clearly a topic that is resonating, but it's very difficult to narrow the protection gap. It requires, I guess, contributions from across the insurance value chain. How do you bring that about?
I agree that it's difficult to narrow, but I don't disagree that there is no solution. I think what is different today, again, let me come back to the interest rates, right? What is different today is that financial repression, the government's actions, whether it's the elected governments or non-elected governments, but their actions to repress the return of government bond yields, that's something of the past. And with higher interest rates, the effect of the interest rates in terms of improvement of combined ratio is massive. A 100 basis points improvement in investment yields leads to a 250 basis points improvement in terms of combined ratio. And I think there's probably no other time than now where the insurance industry's ability to cope with these challenges and the ability to contribute in order to narrow protection gaps, there's probably no other better time than now to do that. Yeah. So I'm optimistic on that front.
Jerome, thank you very much indeed for joining us.
Thank you, Richard.
For AM Best TV, I'm Richard Banks.